Hi, everyone. This is a short screencast covering question 4, James and Anne, in your BPP F6 practicing exam kit, and that's on page 6. Okay, so this covers income tax in a variety of different areas and different tricks under the income tax banner. So quite a good question for us to run through. The first thing I'm going to do is just focus on the requirements as always so that we can figure out what we're looking for when we look through the body of the question. So A1 and 2 here, it looks like we have a Schedule D Case 1 income requirement to calculate that for 2014 year, and indeed capital allowances. So when we see these Schedule D Case 1 and Case 2, we've always got to be thinking about base of assessment rules. In other words, where is this individual James in terms of his possible scenarios? You know, is he opening or commencing in business? Is he in an ongoing or a continuing business? Or is he ceasing to trade? So you've really got to get a fix on how you apply the base of assessment rules to an individual sole trader's accounting profits. Okay, capital allowances here in part 2, a very, very popular area for your F6 examiner, particularly in the area of cars. So you just really got to watch out for the various tricks there, and there are quite a few of them. Okay. Part B here covers rental income, or case 5, and again, I'd refer you to your study text and all those rules relating to the sort of the accruals concept and what you can and cannot include as expenses. So watch out for dates there in particular. And then this part C refers to just really an income tax, computation, income tax liability for a year. And for this particular individual, it looks as if they will be divorced. We know that there are implications or indeed options for an individual to decide whether or not they want to go the joint assessment route or the single assessment route. So, two different possible computations there. We need to work out, how, let's say, maintenance payments, for example, apply to an individual's circumstances, and indeed how they are taxed. Are they taxed with the married credit or not? Okay, so that's the basic setup of the requirements. If I move you up towards the body of the question, I've got some annotations here for you that hopefully will be helpful. Okay, so when we look at the first sentence here, we're introduced to these two individuals, James and Anne. They give us the ages there. Always got to watch out for individuals who are elderly and perhaps the implications on their tax credits, and there will be one for this individual, James. Okay. As we've mentioned below, this individual is self-employed, so which one of the base of assessment rules are going to be relevant? We've got several to consider there. We're given, as you would expect, some accounting profit, and do remember that the base of assessment rules are all about really chopping up the accounting profits and putting them into tax years using those rules. Okay. Excuse me. In terms of the information, slightly unusual the way that they give it to us here. They don't give us year after year after year. They give us a year and then a period and then an estimated period. And this is really a distractor here. This isn't really relevant to the question. In part A1, you'll recall that we're asked to provide the details for the Case 1 assessment for 2014. And they're really putting some information here to try and put you off the track. It's actually fairly straightforward. Okay, so moving on from that, we get some details here about capital allowances, and as you would expect, and as I've mentioned here, that if capital allowances are going to be in play, it must be car related, and there are a number of tricky little rules in relation to cars. I mean, in terms of the basic information we're given the cost of the assets really at the start of this period here, or indeed after the end of it, so 1st of June to 13. We're effectively given an opening cost. And you remember with capital allowances that our key issue is to try and populate that little sort of cost box, as it were, and that will have opening costs, additions, disposals, and closing costs. So really, we've got to get to that box and include cost figures only as quick as we can. Okay, so there's our first figure. Okay, of 50,000 for our opening cost. In terms of the detail here, I'll go into more detail when we look at the answer. But as always, there's some form of purchase of a car, that's in a category, we need to establish what cost to include. There is also a disposal of the car, a little bit unusual in terms of the proceeds. We've got a trade-in and some compensation because the car was written off. We've also got the classic private use trick. So, this area of capital allowances really does give your examiner just all their Christmases at once. There's so many different twists and turns, and you've got to be familiar with each of them in order to be able to score at least 50% in the answer in this particular area. Okay, so more of that when we come to the answer itself. In terms of the balance of the question, we're given some investment properties. So we read that, we've got to be thinking, as soon as I read that sentence there, investment properties, I'm thinking, right, okay, well, what are the likely tricks going to be? And it looks as if clearly, the properties are laid out, property A, B, and C. So I in terms of my knowledge of case 5, it must be, well, rental income less expenses equals profit. So it's highly likely we're going to have 3 little mini P&L accounts or rental income accounts, and we're trying to get the allowable expenses and indeed the rent right with each. Okay, I've said here, this idea of the accruals concept, not mentioned in your text, but essentially what we're saying is that we have a given year, we have a tax year. We're really looking to include only the income and indeed the expenses that are relevant to that year only. So we really have to make sure we watch our dates and prorate based on 1st of January to the 31st of December, and that's the key thing with case 5. It's all really about dates, and what they'll try and do is confuse you with dates. Okay, so very briefly, this property A, it's a residential property. They make that very clear. Let's make sure we know the implications of that. I think it's something to do with interest that can be deducted in some way. Okay, they mention in relation to this property quite clearly that it is registered with the Private Rental Tenancy Board. I'm wondering why they're doing that. What are the implications of this landlord making sure that this property is registered with the board? There is a significant implication of that. Now, in terms of the monthly rent, looks like the property has been rented for a number of years. We've got a monthly rent here. We've also got some annual loan interest, and then indeed some details about some expenses, maintenance charges, and 200 euros to the non-principal private residence authority. Okay. Moving on to property B, this one's commercial, so obviously not residential. What are the implications of that? Again, I think it has something to do with interest. Now, what they do is they play the accruals trick here in one sense, and what we've got to be ready for is this idea of a split between pre and post-letting expenses. In other words, this property was only let from the 1st of July. So what we've got to be aware of is really it's only the expenses from that date onwards that are going to be deductible. Anything prior to that is not going to be deductible. Okay. In addition to that, we see that the property was rented at an annual rent of 50. So if we're saying that we're only taking the property from 1st of July onwards, we've got to say, well, if that's annual, we're looking for half of that, i.e. 1st of July to the 31st of December, not the full 50. Okay, the rents payable quarterly in advance, not too difficult to deal with. Also got a premium here, not covered in the IT section of your study text, actually included within your corporation tax area. And let's just be clear, this issue of a premium, what is it? Well, it's simply an amount of money that is paid by the tenant to the landlord in addition to the rent. And the tax issue for us is that where a landlord receives a premium, then as far as the revenue are concerned, some element of that premium is taxable for income tax purposes, in effect on receipt. Okay, so what we have to do is say, okay, the premium is 50. What element of that do we include in the income tax computation? And there is a formula for calculating that element. In addition to that, we see that the annual interest is 30. And you remember the point that I made above about post-letting and this idea of the property only being let from 1st of July. If the annual interest is 30, then we've got to take a proportion of that, in effect half, and say, well, that's the allowable amount. Okay. Same thing with the insurance. This is this old trick with dates and the accruals concept. If the insurance is 2,000 euros per annum, then how much of that is allowable? Only the post-letting element. Okay, so that will be 50% of 2,000. So the accruals concept kicking in there as well. This property C does include what we would refer to as this industrial building. Again, not included within your income tax sections, included within the corporation tax section of your text. So this may have caused difficulties for you, of course. In terms of this property, it's obviously commercial. It's a creche. It's being run as a business. Certainly not residential. They give you a series of costs here in relation to this building of the creche. So really, in terms of this industrial buildings allowance, I mean, they're effectively capital allowances. What we've got to say is, okay, if these are the costs, which element can we apply a capital allowances rate to? And we'll see more of that when we come to the answer. Okay. In terms of the rental income for this creche, we see that we have rental income of 23k before capital allowances. So obviously the capital allowances can be deducted from that figure. Other information about miscellaneous investment income, deposit interest. Note that it's from an Irish institution. Let's be clear on the implications of that. I think that DIRT will be relevant. So what rate are we grossing it up at? Remember that all income that is included within the income tax computation needs to be included gross. So how do we get this figure in gross into the comp? These items here really relate to sort of adjustments to the comp. We've got some details on maintenance payments for the individual's ex-wife and also for the kids even. So we need to know what are the rules in relation to maintenance payments, and there's some basic rules we just need to be familiar with. We've got some college fees here. This relates to a credit or a tax credit. Again, you know, what's the baseline on these fees and what element of it can be included as a credit. Okay. Some details here on the one-parent family or the single person's childcare credit, and indeed some further details in relation to the college fees. So we just need to know the nuts and bolts of those rules. Okay. So that's the basic question. Let's look at the answer now for James and Anne. And part number one, you'll remember, really was asking us for a Schedule D Case 1 assessment for 2014. Now, it told us within the question that this individual, James, was carrying out an ongoing business. It's a continuing business. So for a continuing trade, it's certainly not commencing and it's not ceasing. So it's that sort of middle scenario. So what are the rules for an individual for Case 1 or indeed Case 2? Where we are in a continuing trade? Well, really it's what I would call current year basis. In other words, it's the 12 months ending in the tax year. So we need to take 12 months of the accounting period. If there was a year, we'd take that. In this case, there isn't. So we're really taking 12 months ending in the 2014 year, and we are given a period that ends in the 2014 year. The only thing is that it's 16 months. So we're really taking 12 months out of that middle period to give us that 112,500. I think they've tried to confuse us a little bit by within the requirements mentioning original and final assessments. In effect, there is only one, and it's always going to be the 12 months ending in the tax year. So there has to be 12/16 of that 150k. Okay. Part two here related to the cap allowances. Now, a fair amount of work to do here on cap allowances for 2014. And you remember what I said, that with cap allowances invariably, what we're trying to come up with is that sort of cost box. Yeah. And what does it have in it? Well, it has an opening cost, additions, disposals, and indeed a closing cost. Now, it's slightly adjusted here. They have two columns, but broadly speaking, that's really what we're talking about. So let's look through it. We see the cost of the assets at the beginning of the period in effect. You know, we're saying that what was the opening cost? And that was given in the question. 50k was given in the question as the opening cost. Now, we know that we have a disposal of a car. Yeah. So that car, as per note 1, was purchased in 2012. Yeah. Now, it is a category A car. And what we've got to be aware of is where we have a category A car, that is purchased, in terms of the amount included, either category A, B, or C, the amount included, or indeed the amount that would have been included within the cost box, is actually 24,000, yeah, rather than 20. Okay, it's a little bit unusual, but that's what would have been included. So therefore, if this car is being disposed of and we're trying to get our cost box right, we've got to take out of, of this area the cost that was included, and it was 24. So we have 50 as opening. Let's take out of the cost box, as it were, the disposal at cost, and that's 24,000. In terms of note 2, the addition of the new car, again, this is a little trick that they'll play on us. We see that this new car was category D, yeah, a category D car. And in effect, what we're left with is two possibilities. The cap allowance is restricted, or the cost that we're going to reduce is either 50% of the lower of the cost of the car or 50% of 24,000, whichever is lower. And in this case, it's the 50% of 24,000, which is lower, because that gives us 12. Okay, so that's what we have to include as the addition. Now, they could have put that figure here, but they decided to put it just to one side because of this private use element adjustment. We didn't have to do it like this. We could have done the private use adjustment down below. Okay, so we have three figures there: opening, take out the disposal of the car at cost, 24, include the new car at the, in effect, restricted value, which is 50% of 24. So then, excuse me, we effectively get down to our sort of closing cost figures, yeah? And all we do is apply our 12.5% rate to those, okay? And these are the numbers here. The private use, again, given in the question, where we have private use of an asset, normally a car, we have to restrict. So we're simply applying 50% to give us our actual allowance of 750, okay? So watch out for cars, quite tricky. Certainly making up this box, those are the sorts of tricks that I would expect to have. Now, we do have this issue, because we've disposed of the car, we really have to look at the tax written down value versus the disposal proceeds. And this leads us on to another very, very popular trick for your examiner, this area here of the disposal of the car. And really what we're saying is, well, we've disposed of a car where the qualifying cost was 24,000. We had 1 year's worth of capital allowances affected 12.5%, 3,000. Therefore, the tax written down value at disposal date was 21. Now, what do we need to do once we get the tax written down value? Well, we have to say, a little bit like net book values within our accounting studies, we have to say, well, what are we getting for the car? Let's compare the tax written down value, which is effectively the Inland Revenue's net book value. Let's compare that to the proceeds. Now, in this issue, and this can be difficult to understand, in this particular issue, where we have, in effect, an adjustment to the cost on an ingoing basis, we also have to adjust the proceeds. Yeah. So in other words, when this car was introduced into the business in 2012, its cost was adjusted. In fact, its cost was adjusted upwards from 20 to 24. In other words, that was the value that it was included at, and you'll note above that we then excluded that value. So when we come up, or when we're trying to come up with this figure for proceeds, we really have to say, okay, what was received for the car? And they complicated it a little bit by giving you sort of two separate amounts. The car was written off, so we were given a trade-in allowance, but we also had proceeds or insurance proceeds, compensation of 2. So the actual amount received was 12. They could have just said that let's say the car was sold for 12,000. In this case, they give it to you in 2 bits. So if that is the amount, yeah, the £12,000, which is or 12,000 euros, which is the proceeds, what we are required to do, given that we adjusted ingoing, we have to adjust outgoing. So we have to say, okay, we're receiving 12,000, but we have to uplift that by the, in effect, the reversed fraction that we used ingoing. That was the value, the 24, that we included the car at, whereas that was the actual cost. Okay, so what we have to do is we say, well, if it's 12,000 received, we have to uplift that by the fraction that we used in effect ingoing. Okay, and that's where we get the figure of 14.4. It's a little bit unusual, and if you're struggling with this, you're in very, very good company. Okay, all we've got to do is just try and understand the concept and just work through some questions as often as we can. So in effect, what we're saying is that I guess the proceeds aren't the proceeds. The 12,000 isn't the correct proceeds. We have to uplift them. And bear in mind, it would work in reverse as well. In other words, where we have a restriction on the cost ingoing, in other words, we're putting in a lower cost. Let's say that the car that we purchased that's gone in at 12, if we're putting in a lower cost than the actual cost, we also have to scale down the proceeds when the disposal of that type of car takes place. So this fraction can work in reverse as well. Okay, so that's where we get the 14.4. That gives us this number above that we're comparing to the tax written down value. The difference between the tax written down value and these adjusted or deemed proceeds is 6.6. But bear in mind that because it's a private use car, we have to restrict them or restrict it by 50%, and that's where we get the 3.3. Okay, so in terms of a summary here of capital allowances, really what we have is, as per the above, we had that private use car at 750, the existing assets again from our little table above, and we have the balancing allowance on the car. Okay, and that gives us the 7.3, which we can include in the computation. Okay, so moving on from there, we have this issue of the rental income. Okay, now remember that I said quite a few tricks in this rental income or case 5 area. I guess the first thing to notice, just by scanning down, you'll see that they have given us property A, B, and C. And really what we've got, all the way down here, and let's try to do this in the exam, is really income, rental income, minus allowable expenses equals profit. And even if we don't get all of these numbers right, we're going to get marks for getting some of the numbers right. So, the rental income, for example, not too difficult to get there. We'd get a mark just for that. The maintenance charge, we get probably a half a mark just for that. So, just bear in mind what you're aiming at is some sort of net income figure across the 3 properties. You may not get it absolutely spot on, but you're trying to score marks wherever you can. Okay, so in terms of the detail here, property A, we knew that that was a residential property, yeah, and just watch out for the difference in treatment between residential properties and commercial when it comes to the interest or the loan interest on the property. As I've said, the annual rent, quite easy to get. I think that the property had been rented for a long period of time, therefore just 12 months times €1,000. Now, in terms of the expenses, and here's where this issue of the interest is relevant. For a residential property, only 75% of the interest is deductible. You must remember that. That trick has got to be played. Got to be played. That gives us the 5250. The maintenance charge, just a standard expense, we can deduct that. And it just happens that this non-private residence tax, that is specifically not deductible. So again, that's just something that we're just going to have to remember. It's not allowable. Okay. Just the other point, you'll remember that I mentioned in relation to property A that the second sentence, or indeed part of the first sentence, said that the property is registered with the Private Rental Tenancy Board, the PRTB. So why was that significant? Well, it's significant because if it's not registered with the board, then interest is not deductible at all. Not 75%, not any percent. Okay, so watch out for that. I guess what they could have done, if they wanted to be very sneaky, is to reverse that. In other words, to say that the property is not registered with the board. That would be a little bit nasty, but I wouldn't rule it out. So because the property is registered, then interest is deductible. But remember that for a residential property, it's only 75%. So that gives us the 5550. Yeah, so income less allowable expenses equals profit. Okay, property B here, a couple of curveballs here, just in particular in relation to this area. post-letting. What do we mean by that? Well, we basically mean that expenses are only deductible from the letting point onwards. And I seem to recall the letting point was there, 1st of July, even though the property had been owned for a number of years. So expenses prior to that date are irrelevant. Okay, so for the rental income purposes, reasonably straightforward. The annual rent was 50. We've got 6 months worth, therefore 6 12s times 50, 25k. Okay, now the lease premium, note that this formula, this area is in fact in your corporation tax chapter, is not in your income tax, which is not overly helpful. But a lease premium, as I mentioned above, is just very simply an amount of money that the landlord receives from the tenant in advance of the tenant moving into the property, part of which is taxable for income tax purposes, just like rental income. But what we need to do is apply the formula. In other words, 51 times the number of years of the lease divided by 50. And that's how we get this element that is taxable for income tax purposes, the 36. So we're really just adding that to the rental income to give us that figure of 61. Okay, so do look for that in the corporation tax chapter. Look for that little formula there, 51 minus n divided by 50, to get the income element of the premium. In terms of the expenses, again, it's the old accruals trick, and indeed post-letting, just this idea that only 6/12 of the expenses are going to be relevant, okay? Because that's when the property was let from 1st of July. And that's where we get these figures of 15 and 1, leaving us with a profit element of 45, okay? Now, property C, they kindly gave us the rental income in the question 23. Point down below about the industrial buildings allowance or cap allowances on the question, which we'll come to in a moment. So essentially what we've got above is 3 properties, rental income less expenses equals profit, and then here we have a summary. 73,550 is the rental income less the 60k on cap allowances. So what is this industrial buildings allowance? Now again, this item is included within your corporation tax chapters, not your income tax, but essentially this allowance, this industrial buildings allowance, is just a capital allowance, just another capital allowance, which just sort of has its own little rules, okay? And we'll come to the detail of that when we cover IBAs in detail. So what do we need to do? Well, all that we need to know is there are several items that of cost that were incurred. What attracts IBAs and what doesn't? Well, the key point was that the site itself doesn't attract. In other words, the land doesn't attract capital allowances. Land's going to appreciate in value. You're not going to get a capital allowance on it. Okay, so on that basis, what does attract IBA? These two. In other words, the development costs and the building costs. Okay, that gives us 400k, and it just happens that it's a 15% write down rather than 12.5 on any allowable cost, and that gives us the 60,000. So more of that when we come on to IBAs. And you should also remember here, or just note the fact that we've got 3 properties. One of them is relevant for IBAs. What we do is we take the profits excluding capital allowances, total them, and then take off the capital allowances from the total, rather than putting the capital allowances in here for property C, i.e. the creche. I mean, at the end of the day, it's going to come out the same figures, but this is what they want us to do. So total the net profits up without capital allowances, without IBAs, then deduct the 60. Okay. So that's where we get the figure of 13,550 for property A, B, and C. Okay, the last part of the question really is a reasonably straightforward income tax computation for 2014. And really, when I see that in a requirement, I'm always thinking to myself, well, there are going to be some marks for doing some very easy stuff, and there's going to be marks for slightly more difficult stuff. So whatever you do in these types of questions, do make decisions quickly and get the information down quickly. There's marks really for nothing at all here. Cheap marks, I would call them. And as I said, 1 or 2 little tricky ones. The essence of an IT comp is certainly to include in the first part the income gross. So what have we got really from above? We knew that we have, or we know that we have case D, Schedule D case 1 income of 112, that was calculated in A part 1. The cap allowances we saw from above were just deductible 7.3. We have dirt income. We've got to be aware of that change from the last Finance Act on the rate at 41%. We're obviously including the dirt gross, and remember that it will have an impact on the comp in 2 other places outside of the inclusion of the income itself. We have the case 5 income, which we calculated above at 13,650. So really, we're looking to just simply populate the IT comp with the gross income. Now we come to this area of maintenance payments for divorced spouse. Now I'll just take you back up to the question itself, and what we have here in terms of this area of his outgoings, it looks as if he has maintenance for his ex-wife. He also has maintenance for his children. And in the requirement it says here that he's not making an election for joint assessment. So I think the key thing for us to remember here is that if he's not making an election for joint assessment, then in effect, where there are legally enforceable maintenance payments for a wife, then in essence, he's going to be taxed as a single individual, a single person, and we're just going to have a deduction for the allowable or indeed legally enforceable maintenance payments to the wife only. The children's maintenance payments are going to be completely ignored. In fact, they're always ignored. Okay, so in terms of the computation, when we look down after we've slotted in the gross income here, which is not overly difficult to do given that the numbers are above, aside from that dirt gross up, we're simply just deducting the legally enforceable maintenance payments to his wife. The children's payments are completely ignored, and we're just going to tax him as a single person. He's not opting for joint assessment. That would be completely different. That would be all the income in effect being lumped into one. Okay, and obviously transferability of tax credits, etc. So if we deduct the maintenance payments, we get to the figure of 115. Move on from that, just down the comp, we're going to get to the tax figures. And you'll see here that we have the 36.8 as the basic band at 20% for this sort of one-parent family, as it were. And that's given in the tables anyway, so we should be able to slot that in easy enough. And then obviously the balance at 41%. Now, in terms of the tax credits, first thing to bear in mind is, as I've mentioned above, he's not being taxed under joint assessment. He's being taxed as a single person. Okay, he's deducted his legally enforceable maintenance payments to his spouse. Therefore, it's a single credit for him. Okay, he's also, or we're told in the question, that he is the primary carer. Therefore, one-parent family credit is going to be relevant. And then in terms of the tuition fees, we just really had to remember that rule for the base level for this individual. I think his 21-year-old son. We're just saying there's the base level, there's the fees paid. The difference between the two times 20% gives us this £1,000 figure or €1,000 figure. And we'll remember that first sentence, we had his age, I think 68. The age tax credit would be relevant, but just one given his circumstances, i.e. that he's divorced. So that's 245. It would be 490 for two individuals living together. The dirt credit, again, easy to forget that, just 41%. Let's try and get all the easy marks that we can. That's simply 41% times the gross income. Okay. And then we get down to, basically, we add up all those credits, we get down to the next tax due of 31,905. So not overly complicated, this question. Some very, very easy marks in certain places. You could have ignored the tricky bits, probably got it done quicker, obviously, and got a pass, I think, reasonably easily if you understand the basic tricks on, not least tax credits, the basic tricks on case 5 income in terms of post-letting and the accruals concept, and obviously those base of assessment rules and the tricks surrounding capital allowances as well, in particular cars. Okay, hopefully that's been helpful to you, and good luck with your studies.